これより本日最後のセッションに入りたいと思います。発電投資と送配電の投資ということで、まずは基調講演を IEA のマシュー・ウィッテンスタインさんにお願いしたいと思います。
Thank you. Let me put this back. Thank you very much, and good afternoon, everyone. Hopefully we've all had enough coffee to get us through the last session of the day. I guess I'll just, this is not my slide. There we go. All right. Do I click through from here? No, I'll just wait for it to come up. So just before, while we're waiting for the slide to come up, for those of you who don't know the IEA, it's the International Energy Agency. We are an intergovernmental organization based in Paris. We've been around for a bit more than 40 years. Our primary focus is on energy security, which these days involves talking quite a lot about the future of electricity. And we're doing quite a lot of work with Japan on its market reforms and also many of our other member countries. So if we could bring up my slides. Are we still? Great, okay. So I'm going to focus my talk on mostly generation investment, but I also want to talk a little bit about transmission investment as well. I think the generation piece is the piece that, at least based on what I've seen today so far, is the one that's driving most of the conversation beyond what's going on the retail side. So just to start off, I thought it would be worth showing what we have been seeing globally in terms of investment trends in different both generating and transmission technologies. Since 2000, we've of course seen a significant increase in investment in renewables. That's that green bar here. And also a relative increase in transmission or networks, transmission and distribution. The fossil and renewables portion, fossil and nuclear portion has remained relatively flat over this time frame, at least in dollar terms. And it's important to bear in mind that when we see the renewables piece in particular, in dollar terms, we're hiding the fact that in capacity terms, there's actually been a significant increase over time. So while these past few years seems flat in investment terms, in capacity terms, we've actually been seeing quite a significant increase in renewables. This should be no surprise to you from the previous presentations and probably your own experiences. But the other piece I wanted to highlight is the most recent investment trends are happening in an environment of relatively low demand growth, which means we are seeing in many markets an increase in capacity beyond what much of the demand growth would by itself potentially suggest you would want to see or would expect to see. So what is driving that growth in generation in particular? Well, it's not wholesale markets. Where we have seen most of the investment growth in generation across the world has been primarily through mechanisms which provide some form of price or revenue guarantee. So PPAs, auctions, feed-in tariffs, et cetera. This red bar, this is where we see quote-unquote pure wholesale market-driven investments. And that's primarily been in the US. And to be completely frank, even here, it's a bit of a misleading figure, because while gas certainly has been driven in some markets by wholesale market environments, this onshore wind piece, that star, which I did not include the footnote here, this does not take into account the fact that there's actually a federal production tax credit, which is an out-of-market mechanism, right? That's not part of any of these categories. So even here, actually, we're not seeing a lot of pure wholesale market-driven investments in new generation, at least in 2016. Just to clarify, this is in 1 year, right? We're about to release the next report, which will include 2017. Unfortunately, as with the BNF report, it's too early to show you those numbers. So I can't give you any hints what that might say. But suffice it to say that at least in 2016, where we're seeing most of the investment is through some kind of either regulated or policy-driven environment, right? Focusing a bit more specifically on thermal generation, And again, looking globally, I wanted to highlight this in particular because I wanted to sort of show where we've seen differentiations between the emerging economies and the OECD or developed economies when it comes to coal and gas generation investments. On coal in particular, and also somewhat to some extent on gas, we're seeing declining trends in investment over the past 5 or 6 years with slight spikes, but generally going downward. But this is, in coal in particular, it's been driven primarily by China, which is this dark blue piece here, which, as I'm sure you all know, has been making some significant changes in policy to its the coal fleet and investments there. When it comes to the emerging economy, developed economy split, in the United States and in Europe, we've mainly seen retirements in the coal sector. We've seen very little in terms of new build. We're really seeing all the new build happening outside of these wholesale market environments, outside of the OECD economy environments. And gas, it's more of a mixed story. We are seeing new gas come out in the United States. We are seeing but we're also seeing some gas retirements. We're also seeing some coal come on in Europe. Some gas come on in Europe, but also some gas retirements. Right? So gas is a mixed picture, but generally speaking, the trend is the same. We're seeing a decline in overall investments. It's a very difficult environment to be in if you're trying to sell gas turbines at the moment. What does this mean in practice? Well, in wholesale market environments, focusing even more narrowly on those, what we've been seeing over the past few years is an increase in retirements relative to new investments. So we've gone from an environment where we have more new builds than retirements to an environment where we have more retirements than new builds. Right? And just looking at this picture, it's actually quite difficult to see what the net impact is. One question that comes up quite a lot, Craig pointed to this in his presentation earlier in the discussion, is the concern over the reliability of power systems given the fact that much of this thermal capacity is retiring. More thermal capacity is retiring than is being built, at least in these environments. How much of that, though, truly is a reliability concern, and how much of that is really more a response to overbuild in the earlier years? In other words, is this a cause for concern or just a reversion to the mean? I think, to be frank, it's right now more a reversion to the mean in many markets. But it doesn't mean that's going to stay that way going forward. It is possible you could, if this trend continues, you would end up in an environment like Texas, where you have a significant decline in reserve margins to the point where there are now concerns about this summer whether they'll be able to even keep the lights on. Of course, Texas says they'll be fine, so long as the weather stays normal. But we haven't had a lot of very normal weather years in the past few years, so I guess it remains to be seen whether that will stay true. Now, looking forward, this comes from our most recent World Energy Outlook. We introduced a new scenario in the last World Energy Outlook, the Sustainable Development Scenario. The details don't matter so much. It's fairly consistent with previous scenarios that look at what we used to call 2 degrees or 450 parts per million scenario. Basically, it's how we meet the Paris Agreement of 2 degrees or below. Right. And in this scenario, globally, not surprisingly, we will see a significant shift away from fossil generation, especially fossil generation without CCS, towards more renewables, more nuclear, and more hydro. Right? And so what this means is we're going to see a significant transformation of the power system across the globe. Coal without CCS essentially goes away. And what we do see in natural gas, this is will primarily be playing more of a balancing role and less of a traditional baseload role. Now, this is probably not a surprise to you, but renewable and low carbon technologies tend to be more capital intensive than traditional gas and coal technologies, more traditional thermal technologies. Nuclear, of course, sits in with these other technology types, which in terms of being more capital intensive. And so as we shift to power markets that are significantly more low carbon, we're going to be shifting to power markets where the investment needs are being driven more and more by high capital technologies and less by low capital and more operating expense intensive technologies. So again, sort of looking backwards, I thought it would be worth highlighting. I have a version of this chart that we used to show for Europe, but I like this one from the US better because it shows investment trends in different technology types over time compared to many different policies that have been enacted over that same period. And the reason I like this chart a little better than the one that I show, the point I make when I show it for Europe is when Europe introduced wholesale markets, when it introduced restructuring, you saw a major shift away from capital-intensive technologies like coal and nuclear, and towards less capital-intensive technologies like natural gas, except for renewables, where they did also see a significant increase, right? But this makes this point in a much more, well, maybe more complicated way, but I think more honest way. There are many different policy drivers that will affect both the structure of the market. So you have policies in here which drove restructuring in parts of the United States. You also have policies in here which drove technology choice by imposing emission constraints on existing coal and new coal. And then you have other policies coming into place which will drive renewables deployment by actively supporting them through subsidies or other forms of support schemes. Right. What this led to in combination is a major shift away from capital-intensive towards less capital-intensive technologies on the quote-unquote baseload side, and a shift away from nuclear towards renewables on the low-carbon, high-capital-intensive side. Looking more long-term, again, going back to our sustainable development scenario, assuming we meet our Paris targets, assuming we meet our sustainable development scenario goals, we're going to see across the globe a significant increase in the share of renewables, even under what we call our new policy scenario, which does not assume the Paris goals are met. This takes into account the Paris Agreement commitments, but those commitments as they currently stand are not sufficient to get us to a 2-degree or below world. But even in that world, we're going to see a significant rise in renewables in many parts of the globe. And so that means we're going to see a significant change, as I already mentioned, on the part of the investment drivers, moving away from low capital intensive towards higher capital intensive technologies. But it also means we need to think about the operational impacts of these new generation technologies on the power system. So I usually play a game at conferences of how many times the duck curve comes up. It's already come up at least once, maybe twice that I remember. So, but I'm committing the same sin and bringing it up again. But I thought I'd at least show you a slightly different version of the chart. This shows net demand in California between 2011 and 2016. And so the picture, for those of you who've seen the duck curve chart, is probably a familiar one. What I wanted to point out is really just sort of to focus more on the question of the ramping needs. And just to show that we're moving from a world where the ramps are relatively stable and relatively consistent and more predictable to one where we're going to see shorter ramping needs, both up and down, and a different pattern, and also, different levels of ramping over those time periods. Which means that we're going to be moving from a world where we need to think less about flexibility to one where we need to think more primarily about flexibility in the system, where it's coming from, how we incentivize it, both from an operational perspective and from an investment perspective. So I wanted to, because I've talked mostly about the US and Europe, and I don't want to ignore the rest of the world again. So I thought it's worth highlighting the fact that really, when it comes to flexibility, we're sort of in a two-speed world. In these blue countries where we have relatively stable power systems, these are ones where demand growth is slow or in some cases even declining. The green countries are ones where we would say they're more dynamic, where demand growth is increasing, sometimes quite rapidly. So in the blue countries, we have relatively little in terms of near-term investment needs purely from a meeting demand perspective, whereas in the dynamic power systems, we need a significant amount of new investment just to keep up with demand. From a flexibility perspective, that means in the blue countries, what we need to think about is how do we leverage the existing assets in the system more effectively? We want to create flexibility or drive flexibility from the assets we already have. We don't want to throw the baby out with the bathwater. So if we can use the existing assets in the system more flexibly, that will allow us to better integrate renewables into the power system, meeting our decarbonization goals while also maintaining the viability of the existing fleet to the greatest extent possible. In the green countries, it's really going to be more about thinking, how do we create the investment environment to create low carbon power systems that are flexible going forward, right? Here, certainly there's existing assets to take advantage of, but it's really more about how we create flexible systems going forward where the investment needs are being met by more flexible technologies. Now, I've talked a lot about generation, a little bit about transmission, but what I didn't want to ignore also was the fact that there are a number of new technologies coming into markets that are taking some of the market away from more traditional generators. This is 3 examples from the United States where regulators are stepping in or utilities are stepping in to use new technologies as an alternative to, in this case, a gas peaker plant, here as a way of avoiding investment in a substation, and here more specifically about how do we create rules to allow storage to play in markets that have been traditionally dominated by thermal generation. The main point I wanted to make here was when we talk about generation needs and flexibility needs, it's going to be really important that we not forget that many new technologies that we are currently only using in a very limited form, storage primarily being used, for example, for ancillary services needs, will play a larger role in power systems, which means generators may not have the market going forward that they expect. As much as I've talked about the need to use existing generation more flexibly, we shouldn't ignore the fact that that doesn't mean they're going to be the most economical going forward as storage and demand response gets cheaper. So hopefully this is all sort of giving you a scene setter for the rest of the conversation. I'll leave it there, and thank you for your attention and time.
ウィッテンシュタインさん、ありがとうございました。それでは続きまして、日本の状況につきまして資源エネルギー庁の鍋島室長からお願いしたいと思います。鍋島さん、お願いします。
Good afternoon, ladies and gentlemen. I'm Manabu Nabeshima. I have been working on designing the Japan's new capacity market for the past year. And thank you, first of all, thank you for attending this seminar. And today, by utilizing this precious opportunity, I will present the Japan's situation related to the investment on power generation plant. So this slide shows the figures regarding the investment on fire plant. Currently, there are 70 gigawatts of coal plant project and 60 gigawatts of gas plant project. 33 gigawatts in total accounts for about 20% of existing capacity. And Japanese government decided the schedule of liberalization in 2013, and it sent signals to the market participants that having competitive power plants would be the advantageous to win the retail competition. And government policy to allow construction of new coal plants accelerated the project, accelerated the creation of the project. But before the construction of thermal power plants began, the cancellation of the project has been already announced. And there are various reasons behind that. And some projects are canceled due to the environmental considerations, and others were canceled because of the downward revenue forecast. So only half of the publicized projects are contained in the official supply and demand plan of utility company, which was officially submitted to the OCTO. So, and as for the retirement plan, while there are not so many publicized plans, but we have to be aware that the retirement plan is announced only prior to 1 or 2 years prior to the actual retirement. And actually, the incumbent utility company are closing their aging fire plants. And this slide shows the OCTO's midterm forecast of demand and supply. According to OCTO, the reserve margin will be as low as 8% in the beginning of the 2020s. And in Japan, the 8% reserve margin is regarded as minimum level to secure electricity supply. And while the incumbent company has sufficient capacity, but they are closing their aging fire plants. And on the other hand, new entrants usually procure electricity from power exchange market, so do not generally have so much power purchase agreement with generation plant. So today, as is the case with the other countries, it becomes more and more difficult to ensure security of electricity supply in Japan. And the story is, as the market share of the new entrants increases and the incumbent power companies are closing their fire plants, and the reserve margin of the power system decreases. So OCTO expressed concern about the long-term electricity supply and strongly recommends introducing the capacity market. And introduction of renewables makes an impact on investment on fire plants. And left chart shows the demand supply forecast in Kyushu area in August this year. The installed capacity of the solar PV is more than 50% of the demand. And we have to consider the availability rate of the solar PV, but still the solar PV accounts for more than 20% of the supply capability in August. And in the past, there are cases that solar PV accounted for as much as 80% of demand in some control areas. Typically, these cases occur in spring when the demand was at a moderate level. So in that case, the system operator has to fully utilize balancing capacity, such as pumped hydro. They pump up water to the upper reservoir. And at the same time, the system operator asks the power generation plant to lower the output as low as possible. So variable renewables, such as solar PV, lowers the usage rate of fire plants and at the same time lowers the market price during the peak demand hours. So this makes it difficult to attract investment for fire plants. So let me summarize the situation. The share of new entrants has increased from around 4% in pre-earthquake period to 12% today. And at the same time, the share of JPX trade in all electricity sales has increased from 0.6% to 7.7%. And Japan introduced feed-in tariff system for renewables, which was introduced in 2013, and it rapidly increases the integration of renewables. So in Japan, significant electricity market reform and rapid integration of renewables have advanced simultaneously, and this created the difficult situation for investment, and it makes it more difficult to ensure adequate capacity margin, and which might increase the price of electricity in the end. So these are the factors that led to Japan's decision to promote further electricity market reform. And we deliberated reform package, a so-called contest package 2 years ago, to carry out the market liberalization. In the reform package, we are going to introduce 5 markets during around 2020. In order to promote competition, we are going to create baseload market to make it possible for new entrants to procure electricity from baseload plant at moderate price. And the first auction of the baseload market will be held next year. And we are also going to change rules of utilization of tie line between control areas. In addition to that, JPX is going to sell financial transmission rights by auction from next year. On the other hand, as I have previously explained the background, there's an urgent need to ensure security of supply. So we have decided to introduce a capacity market in 2020, and which will provide the payments to the generation plants as well as demand-side responses to ensure sufficient capacity is maintained. And a balancing market is also planned to be introduced around 2020, which will enable transmission system operator to procure balancing capacity from other control areas. And finally, we are going to introduce a non-fossil fuel certificate market, which has just opened last month, and which trades in environmental value of FIT-supported renewables. So we expect this market will contribute to more reliable power system and stable electricity price and reduced emissions. And we expect that this market will contribute to sound competition among retailers. The 5 market, including capacity market and balancing market, is going to be established around 2020. And I understand that this challenging situation for power system is not a problem specific to Japan, but it's a common problem for countries to seek more integration of renewables and in a liberalized electricity market. So we wish to learn as much as possible from the experience of other countries, and we hope these markets function well and contribute to integrate more renewables without hindering security of supply. That is all for my presentation. Thank you for listening.
鍋島さん、ありがとうございました。続きまして、マコリーインフラストラクチャー&リアルアセッツのデイビッド・ボールドウィンさんにお願いしたいと思います。
こんにちは。私はマコリのデイビッドです。Macquarie is a global financial services company, and I'm a part of the what's called Macquarie Infrastructure and Real Assets, MIRA. And MIRA is the part of Macquarie that fits into Macquarie Asset Management, and we invest all over the world in different forms of infrastructure, including ports, rail, agriculture, a lot of energy and the like. And my job is to look after energy for Asia Pacific as well as asset management for all assets in this region. You can see from our reach that our energy portfolio, this is generation and transmission, is quite extensive, and we are in all parts of the value chain. 36 gigawatts of generation, about a third of which is renewable, and then through into transmission and distribution for both gas and electricity as well. Here in Japan, we have some infrastructure, including the second largest petrochemical storage terminal facility called Central Tank Terminals, all in this part of the country. When we consider investing in the energy value chain, we reflect on various themes, and these are 3 of several themes that we think about. The first on the left of the page is what you've heard about already today, the growing market share or share of electricity in total final energy demand globally. So the yellow section in that chart is the electricity provision, if you like, or demand for total energy demand between now and 2050. And you can see that that will double its share between now and 2050. So electrification is increasing. And then how is that then met? The middle chart, as you've seen again a couple of times today, is a reflection of the fact that that electricity requirement for the world as being increasingly met by renewables, and by 2050, 80% of the electricity supply will be from renewable sources. And then all of that creates some pressure on transmission and distribution systems in order to maintain their priority. A lot of investments going in to help deliver reliable and safe energy to consumers at the lowest possible prices. So each of these things briefly: electrification, the share of electrification is increasing, primarily due to two reasons. The increasing access that the world has to electricity, particularly in developing economies, is one primary driver. And we're also seeing conversion, fuel switching essentially, from other forms of fuel to electricity, increasing the share of such things as electric vehicles, transportation. In some countries, industrials are converting away from their own form of heat or generation to importing electricity from the market. That will drive that. And increasingly, we're seeing more and more adjacencies and other forms of transportation look at electricity and require electricity to be their primary source of energy. And all of that leads to that increasing market share for electricity going forward. Renewables, obviously, as everybody's heard numerous times, is a primary driver, a theme. The rapid decline in the cost of renewables, a feature in the transformation that's going on across the world. And whilst this initially was driven by policy, we're seeing more and more it being driven by the fundamentals of economic advantages that renewables bring, even in unsubsidized environments. And the charts on the right, which I love, you've seen them before this day, the reflection of the relative costs of renewables compared to coal and gas. So that's a new renewables versus a new thermal. But increasingly, we're also seeing in some countries where the full cost of new renewables is less than the variable costs of thermal. And that opens up a whole nother market for substitution of existing thermal fleets with renewables to meet that, even with the cost of firming included. And that's, again, some countries, and increasingly that will be the case in other countries. And thirdly, this transmission distribution side, there are the two themes: increasing use of electricity around the world, and then the increasing use of renewables and distributed energy resources, all creating stresses as to how transmission distribution systems can manage all of that difference going forward. And we're seeing a lot of money going into this. From an investor's perspective, transmission distribution investments are very attractive for us because they're usually quite big, which we like, and they usually sit within quite stable regulatory regimes which can help give us confidence in relation to our returns going forward, and they often provide expansion opportunities as well. And for vendors of transmission distribution who are looking for partners to join them, whether that be government or private, often it's a way to liberate capital, and we'll talk about one example of that in a few moments' time. So just a few examples of recent investments that we've made in energy around the world. This is the first one. As I said, we are invested in about 12 gigawatts of renewables globally. This one asset is a part of that. Racebank, 573 megawatts of offshore wind in the UK. And why do we like it? In part because for Mira, it's an opportunity to be part of a high-quality asset that's been built well. It serves a growing demand for renewables with a really clear, stable regulatory structure, the Renewable Obligation Scheme in the UK, which is then supported by a strong offtake arrangements, and then all that are underpinned by quality operators and maintenance contractors and so on. So that's a project that we're really excited about recently. Another example in gas transmission, this is Cadent, which is the UK's largest gas distribution network. It was once part of National Grid, and we, in 2007, 17, we acquired a controlling interest in that company. In part, again, because of the confidence we have in the regulatory framework, and in part because we could also see how we as an investor could add value to that asset and bring more efficiencies into the asset to help improve the returns to investors, as well as keep the opportunity for downward pressure on pricing going for consumers in the UK. So it's good for both us and for consumers. And my third case study and final case study is a distribution utility in Sydney, which is called Endeavour Energy. We made that investment last year as well. It's one of the main distribution companies around the region, around the city, and also around New South Wales more broadly. In 2017, the New South Wales state government was looking to sell a controlling interest. So we acquired that 51% interest. The state government retained 49% of the business. What the government was looking to do was liberate capital to redeploy into other critical infrastructure around the state, hospitals, roads, and the like. What they could ask us to do is to obviously invest in that with them as partners. And the government in that case gets two benefits. One is the dividends that are created by that business, and secondly, they're also the indirect regulator of how the price path for transmission distribution would look. So their objectives are twofold, and they're relatively aligned to what we would seek to achieve in terms of predictable, stable, positive cash flows, good returns to our investors, including the government. And secondly, better performance, more efficient performance, and a downward price path for transmission and distribution, which is about 30 to 50% of a residential bill in Australia typically. So we liked it for all of those reasons, and we can also then invest to upgrade the facility. We're doing a very large transformation of all of its core operating systems to bring it up to a point where we can leverage what's now well utilized in other parts of the world of analytics and improve performance to reduce downtime, improve performance, and reduce the cost of the operations going forward. So those are the sorts of things we invest in. And so just in summary, closing, investors like Mira are in many respects natural owners of energy infrastructure, whether it's generation or transmission and distribution. Typically they do sit within robust and predictable, understandable frameworks that regulate the performance of these assets, whether they're generation or T&D, which then enable investors like us to forecast our returns, but then also bring efficiencies to drive costs out of the business. They do provide opportunities for us to add value through innovation and new technologies to, in this case, like Endeavour Energy, to prepare itself and get ready for how it manages all of that distributed energy coming into the system, demand-side management and the like. We can help with making that a system for operators to be confident with their new plant coming on or their new systems that they can rely on. So reliability, low cost, and so on are the critical things. So Mira is really, really happy to be a part of this transition in the world of global energy, and really looks forward to the new opportunities both here in Japan and more around the world. So arigatou gozaimashita. Thank you very much.
ボルトフィンさん、ありがとうございました。それでは続きまして最後のスピーカーになりますインペリアルカレッジロンドンのロバート・グロスさんにお願いしたいと思います。
Okay, so thank you very much, first of all, to Meti for giving me the opportunity to come over here and talk to you. Thank you very much, all of you, for staying until the end. I can see that everyone is still here, which is very impressive for a conference of this nature. So I'm an academic. Every conference has to have at least one academic. So here I am to fulfill that role. Okay, we seem to have lost a slide. Every presentation has had a small advertisement. I was going to have my advertisement for Imperial College. I have part of that advertisement which says, Imperial College, it's a great place to come and study, and we do great research. If you're young enough to want to go to university, then lucky you. If you're older than that, then maybe think of your kids. And we do lots of energy-related stuff. So that's the end of the advertisement. I'm going to use the UK liberalisation experience, or should I say experiment, to make a number of points. There's some detail on the slide, but really what I'm going to be talking about is the interrelationship between market factors, unexpected events, and policy in driving investment, and in some instances, or many instances, in driving investment in unexpected directions, so getting some surprises and unexpected consequences. A very short history in the UK. Like many countries, we were fully nationalised and state-run for much of the 20th century. And we then went through a succession of changes since the 1990s with different regulatory models, different regulatory environments. And then most recently, we went through another round of market reform. Now, I should say that one of the things which overlies all of that is that we have a legally binding target to reduce carbon emissions by 80% by 2050, with legally binding carbon budgets which constrain the carbon emissions in the intervening period. And I think that's a very fundamental driver for change, and it underpins much of what's been talked about throughout today, but it's often taken for granted, the overarching imperative of climate change. So there's some more detail here. I'm not going to go through all of this, but just to say two things. So first of all, during this period, we did have a capacity mechanism. During this period, we did not have a capacity mechanism. During both periods, we had different forms of support for renewables. And in this period, we reintroduced a capacity mechanism. I want to talk a bit more about that as we go through. So 5 years ago, we had a reform, detailed reform act in the British market. It introduced 4 key policies, and I've got them on the figure there. So we have contracts for difference feed-in tariff for nuclear, for renewables and nuclear. So it's not just like a feed-in tariff for renewables. It intends to bring on new nuclear and potentially CCS. A capacity mechanism, a floor price on the European traded price for carbon, and an emissions performance standard. I'll skip through that slide quickly just to say that the mix of generation has changed a lot in the last 25 years or so, from just coal and nuclear through to a more diverse portfolio, including a lot more gas and renewables. So these dots, and this are possibly slightly too small to see in detail, but the idea is to track through history from 1950 through to the current time, when different types of power station were commissioned and how big those power stations were. So that's a history of investment. Some of the oldest power stations, obviously, like the old nuclear stations, have closed, so they're not on the graph. But it shows you nuclear being built in the 1970s and 80s, coal in the 1960s and 70s, new renewables, and this is the dash for gas. So obviously, during that period, the investment conditions would have changed dramatically, and the regulatory environment would have changed too. So I just want to focus on one of those phenomena, and that's the dash for gas. So pretty much everybody who works in the electricity industry has heard of the UK dash for gas. It's often used as an example of rapid change in an electricity market. And so you can see here the capacity that was installed during the dash for gas. That's the 1990s period. And then you can see what happened at the end of that dash for gas period with some large plants here. Now we have electricity market reform. Only one power station has been built in recent years, gas-fired. Now, during this period, we had a capacity mechanism. Was the capacity mechanism the main driver of the dash for gas? Absolutely not. The main driver of the dash for gas was, well, the three drivers were cheap gas from the North Sea, low capital cost, CCGT, which was a new technology at that time, and the market power, which was exercised by two large incumbent market players burning coal, and the opportunity for IPPs and regional companies to sign PPAs to build CCGT to come in and compete away the margins that the two large companies were making. So it was mainly driven by market conditions. It was enabled by policy, but it certainly wasn't being driven by the policymakers and by the capacity mechanism. And come back to that. We've also seen a very remarkable increase in the amount of renewables on the system. There's other policy drivers behind that. We've already heard mention of the renewables obligation in the UK, and you can see a very strong growth in wind in particular, but also solar and some large biomass plants. In the last only really 2 or 3 years, we've seen this phenomenon here, which you can see, which you can see here. This is coal, and coal is being squeezed right to the margin on the UK system. As a result of that, and the increasing share of renewables, we now have about 50% of electricity supply coming from zero carbon, the combination of renewables and nuclear. CO2 emissions have halved. So I think it's quite important to reflect on what the main drivers of that change have been. So the first thing to say is there is a carbon price floor, and the carbon price floor is enough to shift the marginal economics of coal and gas. So the coal stations were previously being burnt, if you like, lower in the merit order than gas. They were running more, and with the carbon price floor, they were increasingly run less. Now, that's part of the story. But again, this is a complicated story, and it's important not to oversimplify. So carbon prices were in there, but also just if you reflect back to that slide where I showed when the power stations were built, those coal-fired power stations are quite simply 40 or 50 years old. They're non-compliant with recent legislation for local air pollution, and in any case, they're coming towards the end of their lives. So we need to factor those kind of wider pieces of context into our conversation about policy. Did the carbon price drive the death of coal? Well, yes. But would it have done it on its own? That's much less clear-cut and much more uncertain. Now, I want to talk for just a couple of minutes about the capacity mechanism that was also introduced in 2013 through the electricity market reform process. Now, when the capacity mechanism was introduced, it was expected that the clearing price would be about £50 per kilowatt. That was the, £49 per kilowatt was the estimate that National Grid made, and they made that estimate on the assumption that the marginal plant which would come forward through the capacity mechanism would be a new CCGT. Now, the UK system is a market-wide capacity system, which means existing plant are eligible to bid into the system, and so you can see, oops, wrong button, oh dear. You can indeed see CCGT together with nuclear and coal, but all of these plants are the existing incumbents, effectively getting an additional payment as a reward for staying open, and partly offsetting some of the wholesale market depression effects that are associated with renewables, which other people have already discussed. But what the capacity mechanism brought forward in terms of new generation was small-scale embedded generation peaking plant, fossil-fired plant, more interconnection, some storage capacity. And this was associated with a clearing price, which is between about 8 and about 20 pounds per kilowatt, so less than half what was anticipated. And actually, that's not terribly surprising, because if you incentivize the marginal new plant through a capacity payment, you would expect the cheapest, lowest cost capacity technology which is available, and that's small fossil plant, not necessarily very high efficiency, but that doesn't matter in the context of the payments for the capacity mechanism, because that plant won't run very often. So that story is a story of quite unanticipated consequences and a shifting of expectation as the result of the introduction of a market mechanism. I'm going to skip this slide because we've already said enough. The cost of renewables are coming down, which is obviously a very welcome phenomenon internationally. Almost my last slide. So this is some research that we did a few years ago, 3 or 4 years ago now, and we are comparing the historical investment. So this is the dash for gas. This is the most recent nuclear power station that was commissioned in the UK in 1994, with the expected investment that would be required for a whole bunch of energy system scenarios that achieve decarbonisation objectives. Now, some of these bars here, particularly for the renewables, will be wrong, because the price, the capital cost of those renewables has come down so much in the last few years since we undertook this research. But nevertheless, it still indicates the scale of the investment challenge which is likely to be required in just the UK example if we're to be consistent with our decarbonisation objectives. Now, obviously that plant has low or zero fuel costs. That plant may bring many advantages additional to decarbonisation, but certainly we need to mobilise a large amount of capital, which brings us back to some of the points that were made previously. So, final slide, if it will move. Just a few observations from me. So the first thing is capacity markets are important. Capacity markets are not present, they're not ubiquitous around the world. Many countries have them, some don't. But in the UK example, the biggest change when we had a capacity mechanism wasn't driven by that capacity mechanism, it was driven by other factors. We can see the importance of carbon prices as a marginal signal for plant utilization, and ultimately as encouraging perhaps plant to be retired. Capacity markets are depend on very, very significantly on how they are designed, and they can, as we've seen in the UK context, deliver some surprises. We've seen these auctions driving prices down for renewables, and what that means is we are within sight of having subsidy-free renewables, but there's a big conversation internationally at the moment about what does subsidy-free actually mean. And in my view, subsidy-free means that you still need to have some form of long-run fixed-price contract, whether that's a contract for difference government underwrites or whether that's a PPA. You still need to mobilize this large volume of investment in order to move through decarbonisation. Now that creates a really fundamental challenge, because on the one hand you want to de-risk that investment and get a low cost of capital, but on the other hand, you want to send cost-reflective market price signals on a marginal price time of day basis to avoid the kind of phenomenon that were discussed this morning with long periods of negative prices or excess supply when it's windy or sunny and demand is low. At the moment, we're integrating that that renewables fleet at very low cost. And the evidence suggests, I've done quite a lot of work reviewing the modeling evidence on renewables integration costs, but the recent UK and German experience suggests that this is being achieved at a lower cost than the modeling would suggest, which shows that innovation, both regulatory and market and technological innovation, is helping to reduce the cost of renewables integration, but there's still quite a long way to go. And so as we look out to the future, I think we can look to get renewables out of their protected bubble, whilst at the same time trying to provide the same kind of maximized sort of revenue stability for investors. So for example, renewables can contribute to upward and downward regulation. They can contribute to system balancing and frequency control. We do need to get flexibility. We can get it in the UK context from more interconnection, we hope, notwithstanding Brexit. We can use new technologies for frequency, enhanced frequency response, for example, from storage. And as we look to the future, we really need to think about some of the emerging challenges. And this is common to both the Japanese experience and in the UK. So what is the future for nuclear? For different reasons, very, very different reasons, nuclear is challenging in both contexts. Obviously, and potentially at least, could provide a large amount of low-carbon electricity. How do we get new combined cycle gas turbines away? And we talk about demand response. Demand response at the moment, at least at the consumer level, is playing a very marginal role in most systems. When the individual household load becomes much more substantial and much more significant, for example, if we had a large fleet of electric vehicles, then the game completely changes because demand response becomes far, far more material and the opportunity to use demand more flexibly becomes very much larger. But that's a great deal of uncertainty around all of that. So that's it from me. Thanks for bearing with me to the end. And thanks again to the organizers for putting this event together.
黒瀬さんありがとうございました。それではこれからパネルディスカッションに移りたいと思いますので、スピーカーの方々は前方のステージの方へお願いいたします。この後のパネルディスカッションにおきましてモデレーターをしていただくのはブルームバーグニューエナジーファイナンスの黒崎様であります。黒崎さんよろしくお願いいたします。
ご紹介いただきましてありがとうございます。経済産業省の皆様、このような場に私をモデレーターとしてご招きいただきまして本当にありがとうございました。Good afternoon, ladies and gentlemen. I'm Miho Kurosaki from Bloomberg New Energy Finance. I'm a moderator of this panel, Investment on Generation and Transmission. A lot of people today, panelists, talked about capacity market, and I'd like to start from the question to Nabeshima-san from METI. Let me actually have a sit. Obviously, you explained and touched upon capacity market, but you haven't really gone into detail how it works. But I would like to actually start from why do we need capacity market for Japan? Could you please explain a little bit more in detail on the background side?
So we are discussing the design of the capacity market for the past year, and the basic structure of the capacity market is for the power producer, they are going to get the payment from the market operator, and Octo will take the role of the market operator, and the retailer have to pay for the cost. And according to their peak demand, aggregated peak demand, so retailers is going to pay the cost of the capacity. And the basic reason behind why we are going to introduce the capacity market is, as I explained, there's no institutional way to secure the supply of secure the supply of electricity. According to the long-term forecast with the supply and demand, the reserve margin in Japan is going to decrease for the coming several years. So it might be seemingly as of today we have enough reserve margin, but it will, considering the time that we need for the construction of the new power plant, we have to take action now, and that's why we are going to introduce the capacity market in 2020.
Thank you. According to Bloomberg New Energy Finance Research, we also expect to see the demand for Japan is decreasing as well. So what do you think about that? You obviously mentioned supply or reserve margin will be decreasing, but at the same time, demand also will be decreasing. I guess that's also a concern. Can you please explain that? And the other thing I'd like to mention is, obviously in your presentation you explained the situation in Kyushu, where that's I think drove the conversation of the capacity market. However, when you think about the frequency of that days during the year, how many days do you expect to see that situation in Kyushu? When we look at the past, we, I think, observed 3 to 7 days, or maybe max 2 weeks during the springtime, where the demand is very, very low, and when we have a lot of sunshine in Kyushu area, where when the solar panel is generating a lot. So I think that's the typical situation in Japan. But since the government or METI will be introducing capacity market, you might also be able to forecast how many days during the year that capacity mechanism will be needed. If you have any insights on that, can you please explain?
So I explained the case in Kyushu area, and yeah, actually, as of today, it's the day is of such a situation. When such situation happened is only limited number of the days, but I would say that in Kyushu area, the 80 gigawatts of solar PV was already installed, and the demand of the Kyushu area is, in the peak time, it's 160 gigawatts. So even in August, the solar PV accounts for more than 50% of the demand, and in the spring, when the demand is at moderate level, the solar PV accounts for more than that. So it means that the utilization rate of the fire plant decreases. It's inevitable, I think, and it also lowers the market price. So for the utility companies, it might be difficult to hold the excess capacity, and it might be more difficult to maintain the fire plant for the balancing capacity.
Thank you. Let me ask questions to Matt. You mentioned in your presentations that, sorry, let me go back to your presentation slides. Yeah, so you explained the global investment is sort of dominated by the low carbon technology, and you mentioned in the graph. And also you touch upon investments in thermal power generation is downward. And also reliability issue, you touch upon that, is a growing concern. And how do you see the linkage between the concern on the thermal power generation and the capacity market. Where do you see the benefit of having capacity market and why?
Sure. So maybe I can sort of break that question up into two parts. One is sort of why might we want to implement a capacity mechanism in the first place, and then why might we choose a market-wide capacity mechanism as opposed to something like a more targeted strategic reserve. On the first question, I think partially it's a philosophical question. It's about risk tolerance. When we look at the reserve margin, we call it a target, but really it could be a target that we might want to meet but are willing to be below, or it may be more like a floor that we are willing to be above but never want to be below. If we think of it as a floor, we need some mechanism in place to ensure that we always have the minimum level of capacity required to meet that floor. In the US, you have examples of markets where they've implemented capacity mechanism because that reserve margin is seen as something that should not be missed. Texas, on the other hand, has decided that it is willing to tolerate periods of time where it is below its reserve margin target. Right now, in fact, this has already come up a few times. It is well below its target. They're willing to tolerate that because they see that as an acceptable risk that the energy market will eventually help to resolve through increased prices, which will incentivize investment or at least help to avoid some retirements. So if the risk tolerance is such that you see that as a floor, then a capacity mechanism could be a good tool to ensure sufficient capacity in the market to meet reliability needs. Then when it comes to the design of the capacity market, I think the reason why Japan is looking at a market-wide, a system-wide capacity mechanism, similar to the ones you've seen in the UK or in the US in some markets, as opposed to a very targeted strategic reserve like you have, for example, in parts of Europe. Well, there again, here you might think of sort of two reasons for that. One, capacity is to some degree a service, in the same way energy is a service. Right? So when a plant provides energy, it can also be providing capacity, which we might want to think of more as availability. If it is available to provide energy when needed, then shouldn't it be remunerated for that service in the same way it's remunerated for its energy service? That's one reason. The other reason is because, and this is perhaps my personal opinion, although I think it's also the opinion of the IEA, targeted reserves, like a strategic reserve, create, I think, poor incentives at the margin. If you take a small amount of generation and bring it outside of the wholesale market and say, we're going to guarantee your costs are recovered in exchange for you not participating in the market, you still have some marginal unit in the wholesale market, which is only going to run occasionally. And that unit now has an incentive to leave the market, right? Because it can either take the risk of occasional energy revenues, or it can take the risk of leaving the market and getting a permanent revenue stream in the form of a strategic reserve payment. So to me, to avoid those long-term incentive problems, it makes more sense to create a comprehensive, cohesive market framework that remunerates all participants in the system for the benefit that they provide to the system.
Would you like to explain in your additional slides?
If we can bring them up, sure, but maybe I can just talk through it. I did have a slide that shows PJM revenues from different markets over time. And what you can see in the chart is that energy revenues over time have declined, but capacity revenues over time have remained relatively stable. So capacity revenues, it's still a small portion of total revenues, right? It's less than 10% of total revenues, as was shown in the PJM slides earlier today. But by being a stable source of revenue, it allows certain generators to stay in the market despite the volatility of energy prices. Now, to the point that was made earlier, though, by Rob, that doesn't necessarily mean that all generators are going to benefit from those capacity payments equally. The generators that tend to benefit most are the ones where the fixed costs tend to be lower because they're able to compete more in the capacity market. It's one of the reasons why you are still seeing nuclear exits, for example, in PJM, despite the presence of a capacity market.
Well, thank you. Rob, you also explained the capacity markets, and you're also trying to explain sort of balancing both, so trying to achieve both two goals of decarbonization and reliability in the system through capacity markets. Is it a good way to achieve two goals, or do you see any other opportunities? And if you can answer that, is there any implications for Japan, because we will be introducing capacity market in 2020?
Yeah, so okay, so thanks for that. So the intellectual rationale for the introduction of the capacity market in the UK, alongside the contracts for difference in the UK, goes more or less as follows. You have high capital cost, zero marginal cost capacity, which you desire to get built, so renewables and new nuclear. You want that plant on the system because that will help you to meet your climate change objectives. Because that plant is exposed to wholesale price volatility, and in particular, wholesale prices go up and down over a period of years because, at least in the UK market, and I imagine it's the same in Japan, the marginal plant is gas. And so fossil fuel price sets electricity price. And so we've heard a fair amount about risk and risk management and hedging and so on. If you have an investor building a gas plant and the electricity price goes up when the gas price goes up, then you have a kind of an inherent hedge for investment in gas. Now, the complete opposite is true if you're thinking about making an investment, say, for example, in an offshore wind farm or a new nuclear power station. If the gas price is high, then maybe you're completely happy because you're making an adequate return on investment. But if the gas price goes down, it's possible that you can't even service the debt proportion of your very expensive investment, and therefore, ultimately, you're unlikely to make that investment because the risk is too high. So the idea of the UK CFD, contract for difference, is that it provides long-run revenue stability so that those investments will come forward. Now, partly because those investments have then been partly removed from the market, but also because of a long-standing phenomenon in electricity markets which is referred to as missing money, which basically says electricity prices will never become volatile enough, high enough for periods of time to reward new investment. The UK government decided to, alongside the CFDs, to introduce the capacity mechanism. And the capacity mechanism, I think of it as an insurance policy. If you were completely sure that the wholesale market would function in the way that, in theory, it should function, you wouldn't need a capacity mechanism because investors would be able to have perfect foresight. But investors can't have perfect foresight. There's too much uncertainty. And so therefore you introduce a capacity mechanism in order to reward investment. And as we've seen in the UK, that price premium can be quite small. So we get more than adequate capacity investment because it brought forward a whole bunch of small embedded capacity, for example, in factories or standby generation or small reciprocating engines that nobody really thought of that was able to provide that capacity at low cost. And because that plant might not run very often, that's exactly what you want. You know, you're providing that peaking service. Now, the problem comes in between those two extremes. It's okay to have cheap peaking plant that makes sure the lights can stay on. And it's great to have new nuclear and renewables to drive down carbon emissions. But what happens to the mid-merit plant? And how does the wholesale price change as these new plants come on at the opposite ends of the spectrum? And in my view, there's a global conversation still happening to try and work out the best combination of a much lower price for renewables, some increased amount of investment, increased amounts of incentives for renewables to be more flexible, a backstop insurance policy of a capacity mechanism, and a mixture of, you know, wholesale prices, ancillary services, and other things. And so that's really that's the conversation at the moment. So I would say that the lesson for Japan is, the first thing is a capacity mechanism provides you with the insurance policy that I think you want. And then the second is to try and get the other bits of the market and regulation arrangements to be as cost reflective as possible.
Thank you. What's your view on that, David? Obviously, you have a global footprint in terms of investment, infrastructure investments, capacity markets, mechanisms exist around the world. And is Japan going to be your sort of targeted country for the investment? And also, Rob's presentation and also the comment currently touched upon the result of the capacity market mechanism created the cheap peaking plant, the investment into cheap peaking plant. It's relatively small size investments. What's your view on that?
Well, you know, the market design is, we've got experts there and yeah, that can speak to that. One of Rob's comments was exactly the perspective of an investor like Mira, which is long-term revenue certainty to bring investments forward. That's the key thing that we look for. And so whether it's a energy only or capacity plus energy or whatever the market design happens to be for energy and climate, provided we can figure it out and we're confident it's going to remain predictable for the period ahead, we're more than happy to work within that context in whatever form. And we do happily operate within a capacity context in the UK in terms of both storage and generation. We're happy to operate in energy-only markets, and that can be in Australia, for example, where the prices in the last week have gone from relatively low right up to $14,000 a megawatt hour for a period when a combination of thermal plant was brought off from planned and unplanned outages. So it didn't get to the point where it was a shortfall, but the market responded, the energy market responded appropriately. So provided we can see how all that fits together, for us, we're happy to invest. We're typically a company that likes to, or a fund that likes to invest in reasonable scale. That's one of the things that we'd reflect on. And there are alternative ways to fund small-scale peaking plants that would be there to provide that physical service to back up the insurance-type product that a capacity market provides. So all of those things, we're happy to support and arrange. But from our perspective, it's certainty of how the market operates, getting confidence around the consistency. And whilst things will continue to evolve, but not big changes, that's the thing that really distracts us. And the one thing that, for example, we haven't yet sort of touched on in this conversation is in the Japanese context. Whilst there's if I can summarize the theory around the need for a capacity market here, essentially, whilst load is shrinking over time, the rate of withdrawal, of capacity withdrawal is more than that. So essentially the margins are compressing, the reserve margins are compressing, but what can shift that quite quickly is the nuclear restart program. And so how those three things come together, load, existing thermal fleets coming off, and whether or not, how fast, how much nuclear comes back on stream, those are all things that can really influence how we might think about Japan as a destination for investment and the likelihood of getting stable, predictable, good returns.
Thank you. As to nuclear restart, BNF, Bloomberg New Energy Finance, does our own nuclear forecast, and we expect to see only 10 to 15% of the power mix in 2030 will be nuclear, which is totally different from the government forecast. Government projection is 20 to 22% of the total generation in energy mix in 2030. And I think it's a critical point, and the nuclear is a critical part of the Japan's energy mix. And I think it's definitely a driver for the capacity market as well. I actually would like to get your comments, Nabeshima-san, on this part.
Yeah, it might be true that nuclear restart might have impact on the capacity market or the wholesale market, but in Japan, the nuclear, we restart the nuclear, but it's based on I think after the national regulatory agency reviews the design of the nuclear plant, and they make sure, after they make sure that the nuclear plant is very safe. And the safety is the priority for Japan because we had the accident after the earthquake. So it might have impact, but I think I would say that we cannot change the timing or which unit should be studied. I think that it's not we can control. We can control or market participant cannot control that issues.
Thank you. I would like to slightly change the topic to flexibility. The thermal power generation obviously can provide flexibility. And is it really better than energy storage? If that's the case, in what way and how? Matt, can you start from?
Sure. So I think one thing that's happening is we're moving away from a world where the presumption of ancillary services, that the presumption is ancillary services will be there when we need them no matter what. Right? That they're sort of a side benefit to the fact that we have all these large thermal plants on the system. But as we move to a world of higher renewables penetration, the flexibility needs will increase, and it's not, I think, necessarily the case that the base provision of ancillary services from existing thermal will simply be there as needed. Right? We'll need more flexibility. As I pointed out in my slides, we need more ramping. It'll be shorter and steeper ramps. Ways of operating that plants haven't necessarily been built for. They could be retooled for, but then they need some economic incentive to retool to meet that need. Right? So you do have examples of coal plants in Germany, for example, being retooled to be much more flexible than they had been in the past. Because there's an economic incentive for them to do that. But I think the other point I made in my slides is that there are new technologies coming into the system which can provide ancillary services very quickly, much more quickly, in fact, than traditional thermal generation because they don't need to spin up or spin down. They simply can't produce as needed. But they don't necessarily produce for as long time as necessarily the system might need. So I think the UK reforms that were highlighted earlier on, I think, are a good example of how things should be moving, which is to sort of think very cohesively but simply about the services that are required and define rules that don't presume a technology up front, but allow all technologies to participate and provide those services, to be much more neutral to the provision of those services. And I think what you'll find is that new technologies like battery storage, demand response, et cetera, will play a significant and growing role, but probably won't ever be 100% of the solution. Probably in the end, you're going to have some mix.
Thank you. What do you think about that, Rob?
Yeah, so broadly I agree. I mean, one thing which is quite interesting in this context is, I don't know if you can recall, I showed a slide which had CCGT built in the UK. The most recent one was commissioned within the last 2 years. Now that particular power station is just under 1 gigawatt installed capacity, and it's actually been designed with the explicit intention that it will be ramp up and down more frequently and be operated at part load. And so the CCGT manufacturers are now bringing equipment to market which has high efficiency at a wider range of outputs. So if you look at the 1990 CCGT, it was basically designed to base load. It can flex, but it loses efficiency. So the most recent generation of CCGT maintain efficiency whilst being operated in the mid-merit on part load. And that's a very important flexibility service that we need in all power systems internationally as the share of renewables increases. I think that with storage, and in particular, if we're talking about battery storage, it has the potential to offer some very high value ancillary service, so basically instantaneous frequency response. But batteries are interesting for lots of reasons. They're interesting because of consumer electronics, they're interesting because of cars. I think that the basic economics of the energy provision through battery storage suggests to me that we are some considerable time away from seeing grid-scale batteries being used for deep cycling. So kind of like being used to charge and provide energy every day for several hours and then recharge again. I think that's an expensive way at the moment of smoothing the demand. It's much cheaper, for example, to use if you're able to more interconnection, more transmission capacity to neighboring regions, some flexible generation, or access to hydro, which can provide very cheap flexibility. And I know from our conversation before the session that there's a good amount of hydro and pumped hydro available in Japan. So I think it's important to just be clear about which system services different plant is able to provide. So batteries, fantastic, huge technological improvements, mainly at the moment being used for very, very fast response.
Thank you. What's the situation in Japan, Nabeshima-san? Flexibility?
I agree with Robert's views, and battery technology is great, but it might be useful to provide fast balancing capacity. But we also need the tertiary reserve or the more slow balancing capacity, and in that sense that the battery technology is not suitable to provide the kilowatt hours or to provide the reserve. So we have in Japan there are many out of the pumped hydro. So for the time being, it's utilization of the pumped hydro is very important to integrate renewables, I think.
Thank you. Japan also thinking of using hydrogen for generation as well as flexible and longer duration or seasonal balancing in the future. Anyone in the panel have any specific views on hydrogen? Matt?
Well, the IEA has been doing some work on this topic. I can't say that I'm the expert, but I can say, so first, I'll get to that in a second. I do want to echo the point Rob made that I think interconnections probably should be seen as the first tool for integration of renewables. Certainly, it's been a great benefit to Europe and other parts of the world as well. But there will be times when you have excess generation of renewables that even interconnections can't necessarily help with, in particular as the share of renewables grows up across all systems. And so then the question becomes, what do you do with this excess generation, right? And I think hydrogen production can be one possible route to both solving the question of how you utilize that excess generation and also potentially solving some of the storage issues, the longer-term storage issues that batteries right now are nowhere close to being able to resolve. The seasonal issues will at some point become critical. And hydrogen production and storage can potentially be a way of resolving that. It also potentially allows you to continue to utilize existing gas infrastructure. So to continue to utilize assets we've already invested quite a lot of money in, so we're not throwing those away just by electrifying everything. So I would say there's a potential for great things, but I would also point to my colleague Cedric Philibert, the IEA, who is more expert on this, and he, I think, recently came out with a publication on this topic. I'd highly recommend reading it. It's free on our website.
Do you want me to have a go on that one as well? Okay, so I mean, hydrogen has been through many fashions. So hydrogen was going to power all of our cars. And then we've been talking about hydrogen for storage and for electricity production. At the moment, again, I keep talking about the UK context, but so apologies for that. There's a big conversation about the potential to produce hydrogen from natural gas and then use CCS to store the carbon dioxide in depleted gas reservoirs in the North Sea. And then that hydrogen would actually be used, it would be put into the natural gas grid, not to provide electricity, but to provide domestic heating. And I don't know whether or not that will prove to be economically feasible. I don't know whether the potential, for example, to produce hydrogen in Australia and ship that to Japan to use for electricity production will turn out to be economically feasible. I think there's a lot of challenges, particularly around the cost of carbon capture, as well as the storage costs and so on, before we can make that work. But I wouldn't rule it out. I would not say that this is never going to happen. I would not say this is impossible. And the reason for that is because we've seen so much rapid technological innovation in a number of sectors in the last few years that's surprised people and has been unexpected. So I think that if we are looking over the course of this century, and if we want to prevent very serious climate change and sea level rise and all of those very unpleasant consequences that would flow from unabated increase in CO2 emissions, then we need to keep all options on the table. And it seems to me that hydrogen being used in some form provides one of those potentially very important options. But it's a bit too soon to say, I think, exactly how.
I just wanted to comment on the Japan situation. So government is thinking to import hydrogen from Australia or Brunei, where they manufacture hydrogen and then ship it to Japan. So obviously it costs a lot more than other forms of generation. So in terms of flexibility, David, I think you have many options to provide flexibility in the system. So I think everyone touched upon thermal power generation, storage as a new technology, hydrogen, CCS, hydrogen plus CCS. From investor perspective, what will be the opportunity for you in flexibility?
Yeah. There may well be an alternative way to think about the 27 gigawatts of pumped storage that sits in Japan right now. That if that's something that is going to be vital for maintaining a stable, reliable supply, then there may well be an investment opportunity that the owners of those gigawatts might want to consider. We're already in doing batteries in terms of in the UK. We're investing in batteries as Macquarie. But the combination, I think, has been pointed out by our experts here of having the short-term response that batteries can provide, particularly in frequency control. We've seen that very effectively played out in South Australia with the Tesla battery. That's been very effective at that role, but relatively negligible impact on, as you pointed out, Rob, and in general in relation to energy. Its role in energy production has really been primarily maintaining the stability of the grid, which is quite critical given that when outages occur, generally governments change. So keeping a stable grid is one vital role. So that very near-term response time of batteries backed up with either pump storage or gas is still for us the most logical approach to sustaining flexibility or providing flexibility, and all of which are really interesting investment propositions.
Thank you. So through these questions, I'm trying to figure out the roles for thermal power generation in the future. It seems that from investment perspective, investment statistical-wise, that there is limited opportunities, and I wonder if there is any changes in its role of thermal power generation going forward, and if you see any changes in the roles of thermal power generations, what is it, and why do you see that changes? Matt, do you want to take that question?
Sure. So if you recall the slide I put up showing the World Energy Outlook forecast for the Sustainable Development Scenario, we don't see fossil thermal generation going away by any means. coal, if it is to play a role, will need CCS in order to meet the decarbonization goals. Right? So without CCS, coal will probably need to go away completely. So perhaps leave coal aside for a second, because I think the CCS question is too uncertain to really address right now. On the gas side, certainly it will be important from a balancing perspective. It will need to play more of a flexibility role and less of a baseload role. And I think, as an example we just saw in the UK, we're beginning to see already investments aligned around that. What I didn't talk about, though, so much was nuclear. Traditionally, nuclear has been seen in most countries as an inflexible resource, something that is just purely baseload in the sense of running all the time. But the experience in France shows that this is primarily, not primarily, there's some part of it that is a technological constraint, but it is not purely a technological constraint. It is, to a large extent, a regulatory constraint we've imposed on nuclear. For some safety concerns, but also efficiency concerns, and to try to deal with the fact that nuclear costs are high, and so therefore high operating rates can help to alleviate some of those costs. There are initiatives now, global initiatives, to try to think about the role nuclear can play in a more flexible power system. One that was announced just a few weeks ago at the Clean Energy Ministerial meeting in Copenhagen. The name of it is Nice Future. I don't recall what the NICE stands for, to be honest. It's nuclear or something or other. But the idea is to look at how nuclear can be a quote-unquote nice part of a flexible power system. And I think that really is something that we need to focus a lot more attention on. If we're going to talk about nuclear as part of the fuel mix in the future, as a thermal generator in the future, we need to think about its role in a system that's dominated more and more by variable renewable energies.
Rob?
Yeah, I can always think of something to say, usually. So I think the first thing that I would say about thermal generation is you need to draw a distinction between coal and gas. And if you're talking in a global context, you need to be in a carbon-constrained world. Then the first and foremost thing that you can do to reduce cumulative emissions over the next few decades is to try and shift as much coal to gas as possible. And we see that happening in some markets, but for example in the US or in the UK, other parts of Europe, possibly in some parts of Asia. But we also see some countries, including quite surprising examples like Germany, where new coal construction continues. And in actual fact, if you look at the example of India, which has made great strides with reducing the cost of solar and wind in particular, it's likely that it will be a renewables plus coal future, because renewables are cheap and coal is cheap in that context. So I think there's first of all is to think on a global context about carbon pricing, or perhaps an emission performance standard, which would help to shift the balance of the marginal plant away from coal and towards gas. That doesn't mean you have to close all your coal-fired power stations, but it would be good if the coal-fired power stations were to move to a lower utilization level, which is exactly what we've seen in my country, and that's been very, very important in reducing CO2 emissions from power generation. I completely agree with Matt that we're going to need thermal generation on the system for many decades to come. It will increasingly be playing a more flexible role and more of a backup role. We do need some combination of either CCS or new nuclear to come forward alongside renewables if we're to meet deep CO2 reduction targets, and if we're going to accompany that by electrification of transport in particular. So we need to face up to that. It's quite difficult to envisage doing it in the absence of one of those two. And internationally, I don't think that the global community is yet really facing up to that challenge. Certainly not doing enough to experiment with CCS, in my view.
Thank you. Nabeshima-san, what's the role of thermal generation in Japan going forward? You know, some people or some group of people sort of criticizes capacity market is trying to sort of protect thermal power generation, whereas there is growing concern around stranded assets.
I think the role of thermal power plant is changing, and the thermal power plants used to be a main source to produce energy, electricity for the power system, and currently the role of the balancing or backup for the renewables has more important, is getting more and more important for in thinking of the role of the thermal power plant, but still it's important. And in Japan, we have a basic plan, basic energy plan, and we predict that in 2030, the 56% of electricity will be produced by the thermal power plants. So it's obviously we still need the power plants, but the difficulty is how we can maintain the capacity of the thermal plants. So the role is changing, and the importance is for the next several decades. I think we still need the thermal plants, but the question is how to maintain it.
Thank you. David, from an investor perspective, is there any advantages or disadvantages in financing large plants or maybe thermal power plants?
Yeah, we're invested in actually in construction in different countries for coal. I suspect that and they'll come to market in India and the Philippines quite well. But I'd be surprised if there's too much more. A year ago, I would say, in fact, I believed a year ago that some emerging markets such as the Philippines and India and perhaps even China had an underlying need for coal, given that the rate of renewable growth was unable to keep up with the rate of demand growth. So therefore the role of coal is to keep the keep the electrification moving along at the rate that demand is requiring it, on the assumption that renewables could not meet that increased demand. I think a year later I've changed my view on all of that actually renewables can achieve the rate of growth in India and China and the Philippines, for example, that originally, at least a year ago, I'd think about coal meeting that growth. In the Philippines, for example, we're invested not just in coal, but also in wind and solar. But another thing we're invested in is 1,300 megawatts of geothermal, which is baseload renewable. And there's a lot more of that that could be developed there. And it's exactly the same role as coal, and it's more economic in the short term and the long term. In China and Japan, we're rapidly investing more and more into greenfields, renewables, solar and wind particularly, and that is keeping up with demand growth, and we're happy to do that. But you also have seen the last couple of weeks China sort of easing back on its approach to how fast renewables gets built out in that country. It's an indication that actually the transition's perhaps a bit overheated, and it's easing back. So thermal will always have that base to fill, but I think in going forward, I suspect there won't be that many new opportunities to invest in underlying coal. And we've talked about gas in the sense that it's a logical place where there is a supply, either a domestic or imported gas, to meet that intermittency that renewables create.
Thank you. We didn't touch upon transmission just yet, but I think Rob, your presentation slides touch upon interconnection, which means transmission. Is there growing investment numbers for the transmissions? And if that's the case, why? Do you have any views on that?
I think if you want an international view on transmission, it might be better to ask Matt. But I mean, I will just make some observations about interconnection. It's almost always cheaper to run some cable than it is to build a new power station. And at the moment, it's more reliable to run some cable than it is to be confident of getting demand response from quite kind of experimental sources. Now, I'm very mindful of the presentations that we had this morning, and I'm an absolute enthusiast for demand response in all its forms as well. I believe that as we look into the future and the load, individual loads, for example, electric vehicles or electric heating become larger, then the opportunities become even more significant. But we're seeing a significant amount of interconnection being built around the British connections into Europe at the moment, like several gigawatts of new interconnection being either built or planned. And that's because, for reasons that were explained, it makes economic sense when those markets are coupled to try and take advantage of any small price differential which a transmission line can access. Now, I don't know how far that conversation might be going in Japan, but perhaps you could be thinking about South Korea, for example. I know there are more political constraints on that transmission, but within Japan, transmission capacity is hugely important. We've seen that in many, many countries. The US even still struggles from a relative lack of continental transmission. Often it's constrained by political factors. It almost always makes economic sense.
Thank you. Matt?
Yeah, I would just echo that. So if you recall from my first slide, the two biggest categories of investments in the last 10 years or 15 years have been renewables and transmission and distribution. And some of that investment in T&D has been in investment in existing infrastructure, upgrades, repairs, et cetera, but a significant portion is in new investment in new transmission lines. And as Robert said, really, very often the obstacle to transmission development is more bureaucratic, jurisdictional, or social than economic. You see this, the example came up this morning of issues with Germany and its neighbors, the issue of loop flows because of the inability to build new transmission lines in Germany. Those issues are being resolved over time, but generally through more expensive routes like undergrounding of cables as opposed to keeping them above ground. But that's basically a choice about whether you want to spend more to avoid the social opposition. If you look at the North American context, there's a great example of a line that was just stopped. Massachusetts wanted to import power from Canada, and to do so was going to run a cable through New Hampshire. And New Hampshire killed the transmission line by objecting to the route, right? Purely for social reasons, there was a concern that it would make certain parts of a very beautiful state look ugly. But this, of course, was to try to get more low-carbon generation to Massachusetts. It was hydro from Quebec to meet Massachusetts' significant decarbonization targets. So it's a significant obstacle to Massachusetts being able to meet its long-term goals. It's, I'm sure a solution will be found, but nevertheless, it's a significant obstacle to decarbonization in the long term if we can't build transmission at the pace that we think is required to deliver generation to load. And we are continuing to look at this from an IA perspective at how to encourage more cross-border interconnections. We're doing a lot of work, for example, in Southeast Asia on the ASEAN power grid and how to encourage its development. We're starting a project literally this month on that, in fact. Not so much on the infrastructure, in fact, but on the policies to support trade. Because that's the other piece of it, is how do you encourage the effective utilization of transmission once it's actually been built. And just within Japan, I'm looking quite a lot at the role of OCTO. And we're actually going to be doing a little internal IA case study on OCTO over the next few months so that I can get a better understanding of the role that it currently plays, but also to get a better understanding of the role that we think it should play going forward so we can provide better advice to Japan and other governments looking to do similar things internally.
Before asking questions to Nabeshima-san, I think I would like to ask questions to David. So you've obviously done a lot of projects on the transmission or interconnections. Why transmissions compared to generation? Is there any preference around that?
No, we're very open to both. I think that energy is a simple case of connecting resources to markets, and usually they're not in the same location. And so the role of transmission is as pointed out, pretty obvious. And we like transmission, we like distribution because they are very capacity-driven revenue streams as opposed to suffering the ups and downs of wholesale markets of electricity and the like. But transmission, even if we're investing in generation, is a critical element. In the case of China, for example, a lot of the wind resources we're investing in, we're building wind up in the north of China, and the markets are obviously not so much in the north of China, they're mainly toward the east. And so we often look for places that have great resources and then excellent transmission to evacuate the power down toward where the markets actually need their electricity. So, a year ago, this one location might be constrained 20-30% of the year in terms of limited transmission, but what China's doing beautifully is to invest in tremendous capacity to enable that renewables to get to market efficiently. Now that's through predominantly state-funded investments, but equally if they were brought to market, we would be very interested in that in any country in the world, as we are in the US and the UK, Australia and other places already.
So just one last question. Nabeshima-san, so I think all of panels touch upon Japan's situation. One is, why do we see any issues around transmission lines within Japan? And I think Matt touched upon utilization issue. Any views from you, Nabeshima-san, on that?
Yeah, I would say that we are making efforts to enlarge the interconnection of the tie line between the control areas, and next year we are going to enlarge the interconnection between the Hokkaido and the Honshu. And currently the interconnection between Hokkaido and Tohoku is 0.6 gigawatt, and next year it will be the 0.9 gigawatts. And it's the eastern part of Japan is the frequency of the eastern part of Japan is 50 Hz, and the western part is 60 Hz. And there's an interconnection between the two parts of Japan. And currently the interconnection is 1.2 gigawatt. But in 2020 we have a plan to enlarge it to 2.1 gigawatt, and in several years we are going to enlarge it for 3 gigawatts. So we are just making efforts to enlarge it. And I would add that enlarging the interconnection is very important to reduce the price differential between the control areas and integrate more renewables. And also, at the same time, it's important to utilize the balancing capacity in other control areas. And currently, the Japanese utility companies or TSOs are using the balancing capacity in their own areas, and in general, the incumbent utility company has summer plants or pumped hydro, and the TSO uses their own, the formerly vertically integrated companies, so their own balancing capacity. But we are going to create the balancing market, and the aim of the creating a balancing market is to utilize the balancing capacity in other control areas. And I think that will contribute to integrate more renewables and increase the security of supply.
In addition, you will also plan to introduce implicit auction system for the interregional transmission lines, and it's going to happen in October. So we would like to sort of see further developments on that area. And also connect and manage, sorry, I forgot the word, connect and manage system will also come into place, and a lot of expectations around both and all those mechanisms coming around 2020. Any sort of your insights or any words to the market participants for today to conclude the session, Nabeshima-san?
Yes, there are many challenges for the Japan in designing the future electricity market, but obviously we have to learn as much from the experience from other countries, and we are making efforts in it, but yeah, I think this opportunity was very precious to learn the experience of other countries.
Thank you very much. Thank you for all the panelists, and thank you very much, everyone, to stay until the end. I would like to conclude this panel. Thank you very much.